Well, welcome to our 2024 State of the Markets for the first quarter. We are so glad that you have decided to join us. This time, what we're going to be doing is we're first going to look through what happened in 2023. We're going to look at the year-end rally, some of the stock and bond markets where we're positioned, and then the economic indicators. Are we headed towards a recession? And what is that looking like? So, Spencer, the other thing that I'm noticing is you have a beard. What's going on there?
I guess that happened in 2023 as well. My wife told me that she would like the look of me in a beard, and so happy wife, happy life. So here I am, ready for service. But enough about me. Let's dive into the state of the markets.
All right, so like we said, we are in the state of the markets for January of 2024. We are recording this on January 12th. The data that we're using is either up to the end of 2023. There may be a little bit of spot data from 2024, but by and large, we're looking at 2023 data here. So as we look back to 2023 and the index returns, we see that everything went up. As we remember back to the beginning of 2022, what we dubbed that year was it was like an investment winter. And when we started 2023, we said, we don't know where the market's headed. We don't know where stocks and bonds are going to go. So as we look back, we can say, okay, there looks like there's maybe been some thawing. We're seeing some of that recovery. The U.S. stock market up about 25.5%. International developed stocks almost up 18%. Emerging market up 9.8%. The U.S. bond market up about 5.5%. And then the global bond market up about 8.3%. What we'll see in a couple slides, though, is the U.S. stock market, though it was driven in large part by some of the artificial intelligence stocks, the large Tech 7 sectors that really had some big rallies last year. But by and large, everything did pretty well over the course of the year last year. So as we break this down by category, what we can see on that left-hand side of the screen, we've got U.S. small cap stocks up about 16.9%, whereas our large cap up about 26.5%. Large value, it was not up as much as their large growth counterparts. So large value up 11.5%, where those large growth companies, again, driven by some of those tech stocks, up 42.7%. So large growth really did well in 2023. As we look to the international side of things, the international developed, international small caps up about 12.6% for the year. International large cap up about 17.9%. Value did a little bit better than growth on the international side of things. So international value up about 18.5%, and then international growth up about 17.5%. Again, coming back out of that winter, we don't know. We never can say we see where the market is going, but kind of coming out, seeing some of that thawing, some of the recovery from down years of 2022. So as we look at our bond indexes, we see the U.S. government, those short-term bonds, up about 5%. The long-term bonds up about 3.1%. We saw, again, some of those interest rates rising, not quite as fast as they did in 2022, but there was some interest rate movement in 2023. So again, as you think about that bond seesaw, the further you are out on that seesaw, the more you're going to get hit by those interest rate moves. But the nice side here is that we were buoyed by some already high interest rates. So bonds were paying us pretty well throughout the year. So again, those longer dated bonds are going to get hit a little bit harder, up only about 3.1%. But again, they're up for the year. And then the U.S. aggregate, including those corporate bonds, up about 5.5%. As we look into alternatives, when we look at that direct lending, so this is the Cliffwater Direct Lending Index, we only have data here through the end of the third quarter. So we don't have the fourth quarter of data. So through 3 quarters in 2023, up about 8.9%. Where we expect that to end out is up about 12%. So another 3% gain for that fourth quarter. But again, that data is only through the end of the third quarter. So our reinsurance bonds are up 19.7%. This is the Swiss Re Catastrophe Bond Index. So we didn't see any tremendous natural disasters last year cause insurers to go over those rates where it's diving into reinsurance funds. So those catastrophe bonds did pretty well, again, up 19.7%. The other piece of that that's a nice boost is that the collateral is in short-term treasury bills. And so those short-term treasuries were paying a nice rate of return. So you get that tailwind for those treasuries as well as a nice rate of return just on those bonds in general. So Spencer, as we look to that 2023 year-end rally, what are some things that we need to note on that year-end? What happened at that year-end?
Well, in sum, the Santa Claus rally came a little early, and that came from the Federal Reserve in late October starting to signal that they might not raise rates any further in 2024, and indeed might cut those rates some. So you can see on our chart here that we had the stock market there, the top line that's in darker blue, falter a bit towards the end of October, and the bond market do the same, although not the same percentage drop. Bonds were underwater, the U.S. aggregate bond index, at the end of October. At the very end of October, again, that news came out, and you can see that stocks responded upward very quickly, and bonds did the same. Bonds didn't have quite the same starting point or quite the same trajectory in terms of their increase, but both responded really well to this concept that maybe interest rates would not be continuing to go up, that if anything, they might be cut this year. As you mentioned, as we look at interest rates coming down in the 5 and 10, 20, 25, or 30-year parts of the yield curve for U.S. Treasuries, we saw those interest rate drops drive bond prices up. So it was a nice rally there for the last 2 months of the year there. And of course, as stocks saw more favorable conditions where they might not be paying as much for their capital costs as they think about the interest payments that they'd have and financing, they also had a tailwind there. If we think about where stocks are positioned overall headed into this year as opposed to where they were last year, this chart gives us a little bit of a guide. The part there on the left side is where we were a year ago headed into 2023. If we have 100%, that would mean that a particular area is right in line with its historical pricing, right in line with its price to earnings ratio over the last 20 years or so. So you could see headed into 2023, we had a lot of arenas that were below that 100%. So they were cheap in a sense. You could see small cap companies in particular were inexpensive, be they value or blend or growth small cap companies. The large growth companies were a touch expensive headed into this year, as were the large blend and large value. As we look over on the right-hand side, though, you would see that those valuations are less favorable to us at this point. Stocks are more expensive by and large in the U.S. stock market than their long-term averages would suggest that they might be. If you think about where the U.S. growth large companies went this year, a really, really strong rate of return, over 40%, as you mentioned earlier, Austin. Well, now those stocks are a bit expensive because their earnings haven't caught up with that growth in their price. The one area that we look at that perhaps is priced a little bit attractively would be those small value companies, again, coming in a little bit cheaper than their long-term averages. Now, if we think about where interest rates have moved over the last couple of years, from 2021 year-end to 2022 to 2023 year-end, in 2021, we really hadn't seen interest rates rise that much. And in particular, if we think about long-term treasuries, those long-dated bonds, 30-year bonds, the interest on those was 1.9% at the end of 2021. Not an all-time low, but very, very low when compared to averages in history. That had run up substantially by the end of 2022. So that interest rate had essentially doubled up to 4% at the end of 2022. And as we look at where it came in 2023, again, about 4%. The story in 2023 is that we saw interest rates rise over the course of the year and peak in late October, as we talked about, only to fall back to about where they began at the end of the year. If we look at shorter dated bonds, by contrast, the 2-year, we see in 2021, they ended at 0.7%. They rose very, very substantially in 2022. So over 5 times growth there in terms of, or increase in terms of the interest rate from 0.7% to 4.4% by the end of 2022. And then they fell just a little bit, those 2-year treasury bonds, by the end of 2023. not a huge amount, only down to 4.2%. And you could see through the course of the year, there were a lot of times that they were actually above that 4.4% starting point that they had coming into 2023. So they've gone down a little bit from there, but still are pretty robust in being in that 4% range. One of the fun things that we get to look into is also the volatility in stocks and bonds. And this will be surprising for some of you. Usually we say that bonds are slow and steady as she goes. They're not going to have the same volatility typically if we look at stocks and kind of look back at history. But that seesaw effect was in full force here if we think about those long-dated Treasury bonds, those 30-year Treasury bonds. So what we've done here is we've identified that on March 9th of 2020, when the COVID lockdown was just beginning, 30-year Treasury bonds hit an all-time low, just south of 1%. If we fast forward from that point, about 3.5 years later, they hit a high, not an all-time high, but a high over the last few years, let's just say, on October 20th of 2023, going up to over 5%. So that's a really big move, going up over 4% over the course of that time. Now, if you bought a bond March 9th of 2020, a 30-year Treasury bond for $10,000, if you held it just those 3.5 years and you saw those interest rates move up about 4%, you're so far off of the center of that seesaw that the increase of those interest rates would have driven the bond price down 60% almost. So down to about $4,094 is what you would have been able to sell that 30-year Treasury bond 3.5 years into its term. That's a huge loss. To put it in comparison to what we saw in the global financial crisis, U.S. stock market, S&P 500 companies dropped 57% from October of 2007 to March of 2009. So we had a comparable drop here in this 3.5 years in the bond market for our 30-year Treasury bond. Now, thank goodness, that's not the only bond that people can own and our clients own. That's a very, very small fraction. Most of the bonds are held at much shorter maturities that had a much different experience. But what we want to highlight is those really long-dated bonds got hit really hard in terms of their bond price. Now, they've come back a little bit as bond prices because the interest rates, again, have dropped a bit since October 20th of 2023. But we do have to be prepared for volatility in our long-term bonds from time to time. If we think about what the experience would be like if we invested in a 2-year Treasury bond and we reinvested in that over the course of that 3.5 years, if we invested in March 9th of 2020, the rate was only 38/100ths% of interest. So if you made that investment, again, March 9th of 2020, you're going to have, roughly speaking, about 0.75% of a rate of return over those 2 years that you hold the bond, but it's still positive. So at the end of that first term, March 9th of 2022, you would get your $10,000 back along with the interest that would be paid over time. Again, you would have made something to the tune of $75 in interest over that course of those 2 years, but still not a loss like we saw on the 30-year Treasury bond. Now, you would then reinvest those funds, and on March 9th of 2022, you would have an interest rate of 1.68%. If you held that, again, to October 20th of 2023, just to compare apples to apples of what the experience would be like for a 2-year Treasury bond versus a 30-year Treasury bond, and you tried to sell that 2-year Treasury bond, again, October 20th, then that bond price would be $9,890. So you would have lost about 1.1% in terms of the bond's value. But again, you would have had some interest over that course of time. So that 3.5-year experience, if you had it in a 2-year Treasury bond, that $10,000, you would have made money on that. Even though that bond price is a little bit underwater, the interest that you would have been paid over that 3.5 years would be that such that your rate of return, if we averaged it over time, would be positive. Very, very different experience, obviously, than that 30-year Treasury bond, where the price dropped almost 60% and the net rate of return would have been in line with what we saw in the drop in the global financial crisis there among U.S. stocks, down about 57%. Now, if we think about where are asset classes right now, how attractive are they when we compare them to history? This slide gives us an indication. This is the asset class valuations. If we put on our nerd hats here and we talk about Z-scores, we're basically saying anything that is negative here in a Z-score is indicating that these investments are a little bit attractive. They're cheap compared to their historical element here over the last 20 years. If we see a positive here, it actually means that these asset classes are a little bit expensive. So walking you through this on the left-hand side there, U.S. core bonds. This would be treasury bonds, mortgage-backed securities, corporate bonds. They started off the year in 2023 pretty inexpensive, 1.1 standard deviations off of their long-term average, okay, to the cheap side. If we see where they sit coming into 2024, now they're not quite as attractive. They're only a half standard deviation off. They've come back more to a historical norm, but they're still inexpensive compared to history. If we look at municipal bonds, again, they started the year inexpensive. Now they're kind of back in line with historic norms. If we think about equities, international stocks are still cheap compared to their history, but U.S. stocks now, whether they're small or large, value or growth, they're all a bit on the expensive side. Now, large companies are more expensive relative to their history than small companies, and growth companies are more expensive relative to their historical numbers than those value companies. And they've grown in that disparity there as we think about what's happened over the last year. So now that we've talked through 2023, let's turn the page and kind of think about where we sit right now and what the indicators are economically for where we may be headed. Austin, what do we see here?
Yeah, so the big thing is there's a question, is there a recession coming within the next 12 months? I think this has been on investors' minds for the last 2 years in a lot of ways, especially as we were seeing that downturn in 2022. There's just been a lot of turbulence in a lot of ways in the markets. And so the question that keeps coming up is a recession coming? And so what we've done here is we've looked at what do certain slices of the society say about the next 12 months. And we go from Fed staff all the way on the left to CEOs that were surveyed all the way there on the right. And so you can see the Fed staff, they've said, or they're projecting that within the next 12 months, that the likelihood of recession is 0%. They do not think that we will enter a recessionary period. This was, again, at the end of last year. So inflation came in a little bit hotter than expected for December. But again, we don't know where this is headed, but the Fed staff seems to think that they're getting things under control. As we look at the yield curve, this is the 10-year Treasury minus the 3-year Treasury, that spread based on data from 1959 to 2009. The yield curve seems to estimate that there may be a 61% chance that within the next 12 months, we'd have a recession. So this looks back on economic data and says, okay, what has happened in the past when the yield curve looks similar? And says, okay, there's maybe a 61% chance. Economists, a little bit closer to where the Feds were than that yield curve, so they're a little bit more skeptical than the yield curve, about half and half. Some think there will be, some think that there won't be. So it's about a 50% chance for economists. When we think about consumers are a little bit more pessimistic than economists. They're more pessimistic than the Fed staff for sure. They think there's almost a 70% chance of recession. Now, some of this comes from survey data that's taken, and consumers, we're seeing media that says that there is a recession. So I think we have to take this with a grain of salt because what you ingest helps determine what you believe. So if you're seeing on the news or within social circles that, hey, I really think a recession is coming, you may be more likely to believe that a recession is coming. But by and large, consumers are saying that they think a recession is on the horizon. So let's turn to banks and see where bankers think that we're headed. Goldman Sachs, it's about a 15% chance is what they are projecting out. Bank of America says it's about 40%. The most pessimistic group of all, though, is CEOs. And they're looking, this is based on data, I believe, through the end of the third quarter for those CEOs. And it's an 84% estimated recession probability within the next 12 months. So that would be through quarter 3 of this year. So CEOs, again, a little bit more pessimistic than the rest of that group. So the one thing we want to think about here, especially as we look back on that October rally and where those magnificent 7 tech stocks did at the end of the year, it can be really easy to look back on 2023 and say, man, NVIDIA did really well. Some of those other large tech companies did really, really well. Is it now time to start looking back and investing in those companies? Well, the reality is, if we look back, there was a Wall Street Journal article written on December 31st of 2009, and they looked back at the decade of 2000 to 2009 and determined that Ken Huebner's CGM focus rose annually more than 18% in the 2000s. That fund in itself outpaced its rivals by more than 3 percentage points. So you would think investors invested in that fund would have done really well. But like we've talked about many times in the past, investors are not great at timing things. Investors in this fund typically lost around 11%. And so if we think about this kind of historically, people don't follow the axiom of buy low, sell high. We often get trapped into buying high, and then when we see a fund drop, then we feel the pain of that drop and then we sell. And so investors in this fund typically lost around 11%. So this is why we want to say it's really important to stay the course and not try to chase those hot stocks or those hot funds that have done well in the past, but really stay the course with the investments. Clients, this is where we come back to over and over and over again, having that financial plan that we come back to, having that investment plan that we know that there's going to be drops in the markets, but we want to be long-term focused with our investments and not sell out at inopportune times or buy when things are really expensive.
Austin, we experienced this firsthand as we presented to high school students here recently and got their take on how they think about investing and gave them some ideas. And as they put portfolios in place, the first couple of days of those investments, the stock market did not do well, and had several of them reaching out and saying, should I sell from this stock? Should I sell from this bond? Have I lost everything? And can I still win this competition? But what we had talked about with them was studies have shown that losses hurt us emotionally twice as much as gains help us. And it was a great reminder that that is who we are at our core if we don't make plans and if we don't act contrary oftentimes to what we're going to see happen to ourselves in the midst of downturns. So it's a great reminder for all of us that as we look at the ups and downs, we want to take those with a grain of salt. Again, come back to the plan that we put together.
So with that, like we say every time, past performance doesn't indicate any future results. All these indices are unmanaged and can be invested into directly. And all of our advisory services are offered through Retirement Planning Services, LLC. If you've got any questions, feel free to reach out. We would love to have a conversation with you. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.